Hello, welcome to the Saturday Summary for November 8th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig of Brokers Alliance here for The Biz, and I'm glad to be back from last week's hiatus. Well, the broad indices flattened out this week after last week's Halloween rally that saw huge rises in the NASDAQ and Russell 2000 indices and big gains for the S&P 500 and Dow Jones Industrial Average. Now, this week saw a Halloween hangover with daily small losses in the indices on Monday and Tuesday, moderate to small daily gains on Wednesday and Thursday, with Friday ending the week flat, despite ostensibly good employment news on Friday and the now expected late day Friday buying panic in the final half hour before the close, which propelled the S&P Dow and the Russell 2000 indices to a slightly positive close. Now, for the week, the markets are up as we see here at the chart, but nothing on the scale of last week. Well, Godzilla inflates the bubble. The latest round of quantitative easing, or QE stimulus, by the U.S. Federal Reserve officially ended last week. That was on October 28th, after the injection of about $3 trillion indirectly into the financial markets over the past 5 years. Now, as our subscribers know, there's been a pretty direct correlation between the 5-year rise in these stock markets and these sequential rounds of QE stimulus since 2009. So, with the end of U.S. QE, why did the markets rocket back up to new highs last week? Well, as the U.S. program ended, the Central Bank of Japan announced a massive 15% increase in their sort of never-ending QE stimulus to the equivalent of $720 billion per year. Now, relative to the size of the Japanese economy, this would be the equivalent of the U.S. injecting almost $3 trillion per year. That's the total amount of the U.S. QE over the past 5 years. Now, in response to this, David Stockman, the former head of the OMB under President Reagan, commented, and I quote, "The scheme is so insane that the surge of markets around the world in response to BOJ's announcement is proof positive that the mother of all central bank bubbles now envelopes the entire globe." End quote. Well, the Japanese central bank move smacks of desperation in an attempt to create inflation in Japan, the world's third largest economy, just as the U.S. Fed has tried to create inflation in the United States. Now, the immediate result of this was that the value of the yen plummeted relative to the U.S. dollar and other currencies, making the, quote, yen carry trade used by big hedge funds and other institutional investors even more attractive than it's been already. Now, these speculators borrow yen and convert that yen to dollars or another currency. Then they buy equities or bonds in that currency. Now, as long as the yen is low or falling and the return on those purchased stocks or bonds is higher than the near zero interest on the yen loan, it works until it doesn't. And it just takes a fairly small move upward in the yen or downward move in the purchased securities to create a situation where it doesn't, then we could have havoc. Well, thus our headline, Godzilla. Now, the original Godzilla movies were produced in and took place in Japan. Now, when the producer of those early movies was asked whether Godzilla was good or bad, he replied to the effect that Godzilla lacks moral agency and cannot be held to human standards of good or evil. He totally destroys everything, and then there is a rebirth. Something new and fresh can begin. Well, to me, that's an ominous analogy to global central bank actions and the potentially disastrous near and long-term effects of quantitative easing attempts to stimulate economies and return to the type of full employment and consumer demand that underlies healthy companies and therefore healthy financial markets. On that note, I think this chart speaks for itself. So, is this rally back from the mid-October lows in the markets sustainable, or is it a dead cat bounce, albeit a big bounce? Is the rally the result of big investors who drive the market showing confidence in the global economy's fundamental health and improvement? Well, of course, nobody really knows, but this week many professional market pundits were opining that what we are seeing is the last leg of a bull market that is going through a topping out process, and remarking that analysis of the rally shows it's actually been pretty weak as regards volume. This chart here showing the S&P 500 index from October 8th through November 4th is indicative of this. The bottom indicators show the relative volume, that is the number of shares traded each day, for this period. Now note that the volume is relatively high when the index is declining and relatively low as it rose. As discussed previously in the summary, volume is considered important as it reflects the conviction that investors have in the upward or downward trend in a market. To quote Investopedia, if the stock is in an uptrend but the up trading days are marked with lower volume, it is a sign that the trend is starting to lose its legs and may soon end. End quote. Well, in other market opinion, see the article on page 7 titled, Why the Stock Market is Weaker Than It Looks. Now, this article speaks to the subsurface weakness in the current rally. The author of that article notes that, quote, there has not been even one session in which trading volume for issues rising in price was at least 9 times greater than the volume for declining issues. It's what we call a so-called 9-to-1 up day. And he further notes, quote, every bull market in history and many good intermediate advances have been launched with a buying stampede that included one or more 9-to-1 up days, end quote. Similarly, the author of the article at page 8 titled This Stock Market Rally is for Suckers provides similar analysis of the underlying weakness of this market rebound since mid-October. Now at page 9, Phoenix Capital Research provides an article with an ominous prediction based upon technical analysis in an article titled, Is the Smart Money Prepping for an S&P 500 Collapse to 450? Now this article echoes several others that appeared in the professional financial press over the past 3 days or so and point out to what is known as a megaphone pattern that is developed in the S&P 500 index, or at least can be concocted. Now this pattern is the result of a form of technical analysis that charts the long-term trend of bull and bear markets in an attempt to sort of predict how high and then ultimately how low the market might go. Looking at the week, what say our friend and colleague Matt Grishman of 401k Masters and Gebhardt Group? Matt?
Hi, John. It's deja vu all over again. Another volatile week on Wall Street. We know what that means for most viewers and their clients. It means lots of fear, lots of worry, and lots of stress. We're probably all wondering if today's rally in the market is for real, or will the selling continue again on Monday? These kinds of unknowns always lead people down this road of worry. And what fuels this worry even further is the constant 24/7 media cycle with opinions ranging from the bull is back to this is just a head fake thanks to the Fed and we're headed into this huge bear market. So what I thought would be helpful for Saturday Summary viewers today is offer some advice on how to take all this information that's available to them and start using it in client conversations, especially for those today who are feeling that enough's enough. You know, if you're feeling like Popeye when he says, I've had all I can stands, I can't stands no more, then it's time to put a new game plan in place and start having these conversations. It's really time to stop being a follower and time to start being a leader. We encourage Saturday Summary viewers to stop doing what the herd's doing and figure out what it takes to lead clients toward a different approach. Once that game plan's in place, then it's time to actually sit with clients and have that difficult conversation of embracing change. You know, John, initially this won't be easy, but I'm happy to report that the only calls we're getting here at Gebhardt Group and 401k Masters from our clients and our members this week are thank you calls. There's no worry, there's no panic. Whether markets go up or markets go down, our clients know we're in the captain's chair ready to react to whatever the markets bring us because we've had these difficult conversations and we've made the necessary changes to get off this 24/7 roller coaster ride. You know, recommending a new approach, John, to managing markets isn't easy. If your viewers need some help figuring out how to put this type of plan in place, you know we're always here to help. Thanks again, John. Back to you.
Thank you, Matt. Well, listen, regardless of why the markets have rallied, be it fundamentals or just on central bank stimulus and sentiment, it's important to remember two things. First, most consumer clients don't really care why the markets are rising. They just like seeing the retirement counts increase. Now, of course, there was much wailing and gnashing of teeth when they declined sharply. Remember the early 2000s and, of course, 2008. Second, over the course of a 20-year or longer retirement, the markets are going to go up, down, and sideways. Thus, the message for those within 5 years of retirement or certainly already retired remains the same. Balance. Make sure you have enough of your retirement savings protected and positioned to provide the guaranteed income you need in retirement to cover at least your basic foundation income for life. Then let the rest ride the markets to provide the additional income you want for fun and family. And you'll be able to do that with a lot less stress and worry. Now, on that note, we are pleased to announce that beginning on Monday morning, November 17th, we will be providing a follow-up segment to the Saturday Summary in which we'll show specific product positioning technique based upon the information we provide in the Saturday summary. Now, this additional written and video tool will only be available to those subscribers who are also producer clients of Brokers Alliance. We look forward to bringing that service to you. Well, that's your Saturday summary for November 8th of 2014. Have a great weekend. We'll see you next Saturday.